Today is Wednesday, 28th of May 2025 Eastern Time. This news is brought to you by Preeti Capital, your trusted source for financial insights. The financial markets presented a mixed bag of signals amid a backdrop of global uncertainties and sector-specific gains. The technology sector emerged as a clear leader in today's trading session, buoyed by strong earnings reports and optimistic forward guidance from several key players. This optimism in tech was enough to lift major indices, contributing to their upward momentum despite other sectors exhibiting more muted performances. Investors remain on high alert as geopolitical developments continue to weave a complex narrative for the global economy. Tensions in various regions have injected a degree of caution, leading to fluctuating investor sentiment. This caution was palpable in the commodities markets, where prices showed volatility in response to the shifting geopolitical landscape. Energy commodities in particular experienced price swings as traders reacted to news of potential supply disruptions and policy shifts in key producing regions. On the currency front, movements were largely influenced by central bank communications and the perceived economic impacts of ongoing international developments. While some currencies strengthened on the back of economic resilience and policy clarity, others faced downward pressure due to uncertainties and risk aversion. Market participants are closely monitoring any signs of policy adjustments from major central banks, as these could significantly impact currency valuations. Overall, today's market activity underscores the delicate balance between optimism driven by sector-specific successes and the caution necessitated by broader geopolitical uncertainties. As investors navigate this complex environment, the interplay between these factors will likely continue to drive market dynamics in the coming days. The focus now shifts to upcoming economic data releases and geopolitical events, which are expected to provide further clarity and direction for market participants. The day's trading session saw notable movements across major global indices, with U.S. markets leading the charge in gains. The benchmark index, representing a broad swath of the U.S. equity market, surged over 2%. Reflecting robust investor sentiment and possibly strong corporate earnings or positive economic data. The technology-heavy index outperformed, climbing nearly 2.5%, indicating a strong rally in tech stocks, which often serve as a barometer for growth and risk appetite among investors. The industrial average also posted significant gains, rising by close to 1.8%. This upward movement suggests that blue-chip stocks, often seen as stable and reliable, are benefiting from the current economic landscape. The small-cap index outpaced its larger counterparts with an increase of nearly 2.5%, highlighting investor confidence in domestic-focused companies, which tend to be more sensitive to changes in the U.S. economy. On the volatility front, the index measuring market volatility fell by nearly 8%, a substantial decline that points to a decrease in investor fear and uncertainty. This drop may underpin the day's bullish sentiment and suggest a more stable outlook in the near term. In Europe, the major index in the UK saw a modest rise, just shy of 0.7%, while the leading German index experienced a slightly higher increase of around 0.8%. These gains reflect a positive sentiment in European markets, possibly driven by favorable economic indicators or corporate earnings reports. Asian markets presented a mixed picture. The Japanese index experienced a modest gain, while the major index in Hong Kong dipped slightly, indicating some regional disparities in market performance. Meanwhile, China's main index showed little change, suggesting a wait-and-see approach among investors, possibly due to ongoing economic uncertainties or policy announcements. Overall, the day's movements across these indices illustrate a generally positive mood in global markets, with particular strength in U.S. equities amid reduced volatility and mixed performances in Asian markets. In the current financial landscape, bond yields have shown notable movements, reflecting a complex interplay of economic forces. The 10-year Treasury yield has recently declined to 4.434%, marking a significant decrease of approximately 1.66%. This movement suggests a shift in investor sentiment, possibly driven by changing expectations around inflation and interest rates. A lower yield often indicates increased demand for these safer long-term securities, as investors seek stability amidst economic uncertainty. Similarly, the 3-month Treasury bill yield has dipped to 4.203%, a reduction of about 0.64%. This decline, albeit less pronounced than that of the 10-year yield, indicates that short-term expectations are also adjusting. Such a movement might reflect market anticipation of potential Federal Reserve actions or a recalibration of risk in the short term, possibly due to geopolitical events or domestic economic data releases. The 30-year Treasury yield has experienced the steepest drop among the three, falling to 4.94%, a decrease of around 1.81%. This reduction highlights a reassessment of long-term economic prospects. A declining yield in this segment often signals that investors are forecasting lower inflation rates over an extended period or are anticipating a slower economic growth trajectory. The overall downward trend in these key yields suggests a pivot in market dynamics, where investors are increasingly cautious about the future economic environment. This could be attributed to various factors, including recent monetary policy signals, changes in fiscal policy expectations, or global economic developments. The bond market's reaction serves as a critical barometer for broader economic conditions, providing valuable insights into investor confidence and the anticipated trajectory of economic fundamentals. As these yields adjust, they will continue to influence borrowing costs, investment decisions, and the broader financial ecosystem.